So yeah, we lost a couple of our panelists, I think, to flight delays or flight cancellations. So there's going to be more airtime for you guys, I guess. I think originally we wanted to tackle family offices investment in the space, but because the two family offices that were going to pretty much tackle the issue, obviously have cancellations in their flights, so we can, I mean, we can broaden the subject really as we like. So I know you guys, I mean, you Patrick, you'll introduce yourself, but you don't only look at this space from a family office perspective, and yourself, Bob, is you are, sorry, a kind of a hedge fund specialist, right? So we'll start by doing introductions first, and then we'll tackle the subject. Yeah.
All right, Patrick Martin. I run a family office based in London. By background, I'm a serial entrepreneur. Used to run media entertainment companies. Had a few successful exits, IPOs, and since been investing in tech from a family office since 25 years. Crypto since about 10 years. And yeah, it's a wild ride. So, to quickly answer the question, more crypto in the portfolio is better than less, I think.
Yeah, obviously. That's why we're all here. Bob?
Perfect. Thanks everybody for coming. So I run 319 Capital. We are a fund of hedge funds, so we allocate capital to mostly quant systematic funds in digital assets. So 100% of our portfolio is in digital assets. We cover mostly three key strategies. So the high frequency trading space, the market neutral space, and DeFi. And I mean, I would also say obviously the more crypto the better, but happy to answer sort of or opine on what we see from the other side. So when we're going through the due diligence, what are the key questions that family office ask us? What is it that we need to provide to them when it comes to the portfolio and similar. On my personal side, so I've been in digital assets in crypto since 2017. Participated in the ICO era, so sending money to strangers over the internet, no problem there. And then started to allocate to funds in 2021, and now running 319 Capital.
Cool. Myself, I was a PM for a decade for a company called Wealth. It's a TradFi company that's got a third of its AUM in crypto. I was managing a couple of portfolios there, discretionary and also quant strategy. And I've left Wealth, and now I've set up Juno Capital, and I'm partnering the big player in the space to launch my strategy there. It's a systematic quant trend following strategy. So I think we were supposed to tackle the family office kind of perspective in the space, and I was actually looking at a Goldman Sachs recent review of the family office investment in cryptos, and apparently the interest or the percentage of family offices investing hasn't really changed from 2023. So 2023 it was about 26% or a quarter of family offices had some kind of investments in cryptos. In 2025, so this year, that jumped a little bit to 33%, so from 26 to 33%. So a mere like few percentage points rise. And in the meantime, we've obviously seen the Bitcoin ETFs being approved in the US, so all the institutional adoption. We've seen the massive $1 trillion money managers such as BlackRock and now Vanguard, by the way, offering ETFs to their customers. So why do we think that the family office interest hasn't risen within those 2 years? Do we? I mean, are they more crypto native? Like they haven't been involved in ETFs because they prefer storing their bitcoins in cold wallets, or is there still skepticism in this space from their perspective? What do you guys think? We'll start with you, Patrick.
Sure. So that's an interesting number. Okay, so a third of family offices now, 33%, have crypto exposure. I think that number is probably underreported. I would think I mean, of course, I meet people more in the context that are already there, but I would think it's probably more half. But because there's no reporting requirement for a family office, they do what they want, and then they buy Bitcoin when they want to. I think in terms of Bitcoin, it's probably more towards 50%, and other stuff we don't know. Of course, allocating to funds and allocating to more structured strategies, that might be the case. But I think let's say the 50 or 60% that doesn't have crypto, they're missing something, because in a classical portfolio, for a liquid portfolio, allocation in crypto or in Bitcoin especially is now proven to be very beneficial. It lowers the Sharpe ratio, it increases the upside of the portfolio. So it's if you look at it from that way, you should do it. Of course, if you're a real estate family and the only thing you do is real estate development, then maybe you don't need to have Bitcoin. But I think it's I would think there's still work to do. I mean, if we say family offices have 33% of family offices, that's a lot more than of retail investors, right? Because if you count retail investors in the world, maybe there's 5 billion retail investors and maybe 500 million have wallets. So it's 10%. So it's already an outperformance.
Yeah, family offices are smarter than retail. What do you think, Bob? Do you think, like Patrick, we have an underreporting of family offices crypto investments? Does that sound like a good number to you, 33%?
I'm actually surprised it's that high, if it's really that high, because most of the people that I speak to, they are interested, but they have close to zero exposure. And maybe I'm spending time on the wrong side of the spectrum, really kind of evangelizing and being out there. But most of the people that I speak to on the family office side and high net worth individual side, they probably are very allocated to real estate, they are allocated to private equity, they own operating businesses. But very often is the very traditional side of the assets, and so I really need to, Bitcoin 101. How does blockchain work? How does Bitcoin work? And so, if it's 33%, that seems quite high. I would say it's definitely lower, or I think it's lower, and I think the reasons for that is, one is from which pocket will the family office finance that investment to digital assets, be it Bitcoin, etc. Is it from a liquid pocket that already exists? Is it from cash flows, from operating cash flows that they will get? They need to basically find a space for it, find a pocket. And I guess second is the reason why that number, again, seems to me quite high. Inside the family offices, you don't have specialists for digital assets, or you don't sometimes have specialists for liquid. You have someone who needs to cover the entire spectrum from liquid to illiquid. And again, the education point comes in. They have only so much little time to spend on something that, yes, it's growing, but still, it's a small piece of the total pie.
Sure. Yeah. I mean, I guess when they ask these family offices, maybe some of them have allocated like 1%. I mean, they just open a wallet and just bought a few Bitcoins, and that's accounted for an investment, basically. Or okay, let's move on. Let's talk about a bit the portfolio construction and how you guys integrate digital assets within your portfolios. Do you have specific strategies that you avoid or you prefer to do? Are you more into liquid venture? How do you diversify, or how do you get allocation? Are you more into the Bitcoin mining space? I mean, I've spoken to Kira. She's not here, but she said from her family office's perspective, they're mainly in just Bitcoin, long spot Bitcoin and Bitcoin mining. So it's very much kind of early stage exposure from that perspective. How do you guys integrate your exposure?
You want to start? Because I think from your having a more like a traditional perspective.
Yeah, so I will take it from the other side, meaning the people that I talk to, into what pocket we fit in, and when we have the discussions where we fit in and what I see. So very often the family office that I speak to, when they have exposure, they have it through a venture fund. So basically they have a venture capital allocation, and that venture fund, be it a generalist or a specialist, has done some investments in the space, most of the time equity. Some family offices, they have allocated to specialist digital assets venture crypto funds, basically. I would say is the smaller part. Some of them, they went sort of one step further, recognized that actually generalist VC firms are not necessarily good VC for crypto, for digital assets, and so they went to fund of funds. So that's one allocation that I see in place. Second is on the liquid side through an ETF. So that's really the history of the last 2 years, where people, for family offices, is literally as simple as buying a ticker or an ISIN type of product. It's through an ETF or ETP type of product, both in Europe and the US. Those are the two simplest one. Now, where we sit, so we are a liquid fund of funds, so we offer basically 2 months liquidity. So we would fit into a liquid pocket. That's how they think about it, where they can potentially call the capital back, and that sort of situates us somewhere across liquid, basically equities exposure, and credit. That's liquid credit.
Okay, so liquidity is key, right? I mean, the panel before us touched upon diversification and the need to diversify, because when problems emerge, obviously assets get correlated to one, and then obviously everything goes down. So flight to safety from that perspective is important. Patrick, how do you get exposure in the space?
Well, let me start with saying what I hear other people are doing, because I'm probably an outlier, because my allocation to crypto is about 60%. So it's maybe not from a risk-adjusted basis, it's not the ideal allocation, but I'm a strong believer. So I'm trying to triple my money overall, right? And so I can't do it with a small exposure. But
Nice.
like most family office I talk to, first they buy Bitcoin. So they usually have some allocation either directly to Bitcoin or to maybe the Bitcoin ETF. Then, I mean, Coinbase is an easy one, right? Because if you buy Coinbase, you definitely have exposure to the crypto space, and that's a pretty safe one. A big family office from Argentina, I just spoke to, a multi-billion family office from Latin America. They have some stock, they have some Bitcoin, and then they just bought some Kraken pre-IPO. So I think that now that the crypto companies are going public, I think the exposure will increase very quickly, because these are the high vol, fast moving assets, and then it becomes very easy to buy it just with your normal share portfolio. I think the reason people don't have exposure more is because it's more difficult, right? If you're a structured family office, you need to, if you want to have a self custody, you need the wallet infrastructure that people don't have, then don't want to have. Or you need to set up a crypto account with Binance, so that's a regulatory problem if you're a regulated family office. So I think it's all happening now, because now Morgan Stanley just came out last week saying, okay, they recommend for sort of like a medium portfolio with medium risk, 2% crypto, and then for a more aggressive portfolio, 4%, and this is for multi-trillion-dollar allocation. So if this is a Morgan Stanley recommendation, there's a lot of money coming, right? And this is, everybody will eventually have to have it. So the laggards will be left behind. But I think in terms of a portfolio allocation, you now need to have somewhere between 2 and 5%. Makes a lot of sense.
Yeah, I'll probably add that from my perspective, my experience at Altana Wealth, which was a traditional asset manager. So they approached the space. Actually, they were quite early. So first of all, they started a Bitcoin investment vehicle back in 2014. Bitcoin was about $400. The first 6 months, that small investment vehicle, which was a friends and family money, Bitcoin dropped to 260. Everybody laughed and said, haha, we told you it was a scam. Then obviously these early stage investors then did 100x. But within that 100x journey, so they've seen 2-3 bear markets, right? Like you quadruple your money, and then comes a bear market, you do minus 60% drawdowns, then again 3x, and then minus 80% drawdowns. So those early stage investors approached us and they said, all right, you guys are traditional asset managers, why don't you profit a little bit from the volatility? It's a very cyclical asset class. Try to capture both large breakouts on the upside and on the downsides when there are bear markets. So that's when we introduced long short. So some of these investors allocated to this strategy, and also in the meantime we obviously did look into the market neutral side of the trade, which I presume a lot of asset managers did in 2023 and 2024 as well. The carry trade, so you go short the futures, long the spot, and you pocket the funding rate. So that evolution of exposure, I think, came naturally as I think the entire asset class matured. Now, from a family office perspective, when I spoke to Kira, I remember when we prepped for the call, and Bijan as well, they didn't seem to have a lot of exposure into these more active kind of strategies in the space, like ourselves maybe are more looking into it. So family offices are still kind of more, earlier, and I'd say probably from that perspective, they probably did better. To be completely honest, I mean, buy and hold strategy in Bitcoin has been the best strategy of the last 5 years, and family offices were mainly invested in Bitcoin and probably trying to get some yield on top of these Bitcoin holdings. Also, some Bitcoin mining was also in their portfolio. So, will it stay the same? Will we obviously see Bitcoin being still the king in the future? I mean, obviously this remains to be seen. But I think they are still. They are now cognizant of the fact that things can change, and Bitcoin is now king, but potentially you have to look into other strategies, at least from a diversification point of view, because even Bitcoin can have large drawdowns, right? Okay. Moving on, I think one subject we wanted to talk about is what differentiates a family office perspective or view of investing in the space from a normal or a traditional asset manager or a hedge fund, right? Like obviously there's probably a higher a longer time horizon. Because of the fact that they're family offices, so they have a longer outlook in the space, and probably hedge funds are they have LPs to respond to, so monthly performances, etc. How do you view that difference of difference in terms of what they can invest in and what they cannot?
Well, firstly, there is not the family office, because a family office is a contrived term. It basically just means it's a pool of capital that usually comes from a family that had a business that was generating cash flow that they either sold or still generates cash flow, but there's no rule of what they can do. So a family office technically can do anything they want, and they can basically say if the principal of the family office is 80 years old, they're probably going to be focused on capital preservation. And if the principal is 35 years old or 40 years old, they were probably going to be trying to grow the wealth. And then anything in between is possible, so they can really do what they like. Multi-family offices is slightly different because that's more a more regulated structure, but a single family office, they can really do what they like. And it depends on the appetite of the family members. Is it needs to generate cash flow to give lifestyle choices to the family members, or does it need to just grow the pie because they have cash flow from other sides? So it's you can't really define it as what does a family office do. But from my personal point of view, I'm trying to grow the pie, and I'm willing to take risk. I have a lot of venture investing in my portfolio. So the liquid side is a smaller side. And I don't consider it liquid. For me, Bitcoin is a base asset. It's like the S&P 500. So I trade, when I exit venture investments, I trade back into Bitcoin. So I accumulate Bitcoin over time. But that is a very specific to me, because I'm happy with the risk. So I'm happy if I have a 20% drawdown in Bitcoin, because I can buy more Bitcoin cheaper, right?
So you have a longer time horizon, Patrick. Yourself, Bob?
The more Bitcoin, the better. So I would
Bitcoin
say
is better than less Bitcoin, and then don't rebalance.
I would say there's a big difference in sophistication and in terms of the call it the quantitative support that hedge funds or traditional asset managers require when it comes to allocation. What I mean with that is family office is not that they would not be sophisticated, but again, the CIOs, they have so many other options that they need to consider, and I would say the decision to invest, I would say, is based obviously on quantitative measures, the fund, etc., but it's much more about the people and what is it that you're trying to achieve. When I look at the people that I speak with who are much more professional allocators, we're talking much more statistics. We're talking about drawdowns, we're talking about Sharpe ratios, we're talking about volatility. That does matter to family offices, but to a lesser extent. It's more about capital preservation. So there, the one key metric is the drawdown. How much drawdowns are you targeting? What is it, the risk that you're taking? I would say financial managers is much more quantitative statistics that you need to present.
Interesting. I think, yeah, I mean, from my perspective, because I'm probably biased because I run a long, short, systematic strategy. But what I tend to explain to, my potential investors is exactly what you said. I mean, drawdowns are the most, I think, important metric, in my opinion, when you want to venture into the active space, right? Because if you look only at Sharpe ratio or just volatility, obviously these strategies actually by definition try to make money from volatility, right? Especially trend following. So when volatility is high, that's when you will see breakout on the upside or the downside, and that's when you're active in the market, right? Trying to buy, right? If there's an upside breakout, or sell, vice versa, right? So by construction, you will make money in high volatility regimes. So if then people will judge you on a high volatility pure metric, that's obviously not going to make it for you. So I advise people to look more into drawdowns, because there is a way to actually achieve a low Sharpe ratio, but with a high karma ratio. Karma ratio being your excess return with regards to your drawdowns, and I think that's a more important metric. Another one, I think, in my opinion, is how you fare during market stress. So last Friday was obviously a very good example, but also what happened during the FTX collapse, or when correlations really go to one, right? How did your portfolio fare? What was your max drawdown in these instances, etc. So from an active management perspective, I think lots of metrics are there for you to look at, but I think max drawdown is one of the most important ones. I think before we go into the kind of looking ahead and what we're interested or what we're excited about, I'd love to get your view about what valuation metrics do you guys use, right? When not just to allocate to a certain manager, but like if you look at a project, especially yourself, Patrick, because you tend to invest VC, so you meet founders, etc. So how do you, apart from just obviously liking the team or not, but how do you value a project before investing in it, when there are no metrics?
You mean in the venture side?
Yeah. On the VC side, yeah.
Well, if it's early stage, the only thing you can do is look at the team, see how much experience does the team have. Is the team technically capable to do what they say they can do? And then ideally get a reasonable entry valuation, but it almost doesn't matter, because if I'm investing in venture, my expectation is either zero, so it's a total loss, or it's 10 to 50x. And so if I made 10 investments and one of them goes 50x, then I made 40x, even though I lost 9 times the other things. But this is a very specific way for me to look at it. So at the end of the day, do I invest at an 8 million valuation, a 5 million, or a 12 million valuation? It doesn't really make a difference. It just makes a difference if the team, if they already have some kind of a product that makes sense. Even though I'm looking more on the like a later stage stuff. pre-IPO, and then of course you have metrics. You have revenue, and so we're looking at revenue multiples and profit multiples if they are profitable. So there is actually now profitable crypto companies, which wasn't the case 5-6 years ago. And so of course then you can apply normal metrics, and then of course now you have listed crypto companies. You have Circle, Bullish, Gemini just went public, Coinbase. Robinhood is a crypto company, so you have now metrics on the public market, and then you can apply those to private markets, and then you can find a valuation. This is for more mature companies, but that makes sense. And of course, there should be a premium to public market valuations because of more liquidity. But that's the kind of stuff I look at.
Okay, Bob, how do you see that?
So, before launching or allocating to digital asset hedge funds, I spent close to 10 years in private equity, so very sort of familiar with the traditional metrics and finding it really hard to apply them to or justify some of the crypto valuations. Why would Solana be at 200 billion market cap? Why would Ethereum be at such a high market cap? And so maybe that's why I sort of shifted to more liquid strategies where that does not matter as much. But if I sort of tweak the question slightly, how do we select managers? What are the key criteria that we look at when we evaluate the hedge funds that we invest in? So there's kind of 4 key buckets that I spend time on. So the first one is, what is it the strategy that they're running, right? So if they are basically selecting altcoins, that obviously is something totally different. We don't do that at all. So it needs to be sort of purely quant systematic, based on large models, algorithmic execution. There can be obviously some manual trades, of course, but that's the key. Second is these strategies, how do they correlate to what we already have in the portfolio? Do they have better results? Do they have worse results? How much do they correlate? Do we want to replace our existing portfolio and put someone new? The third one is the managers. So the team behind these strategies, what are their obviously technical capabilities? What is the background? How strong is the team? Literally, how many people do they have? And where they are in 2022, sorry, when FTX happened. And again, it's fine if they had money on FTX, but did they have 90% or did they have 10% there? And then 4, which is kind of again specific to digital asset crypto managers. Where do they trade? What is the infrastructure that they are running, and what exposures can you see from there? Again, I believe it's fine to trade on Binance, as much as a lot of people don't like other exchanges. But again, how much money do they have on exchanges and etc.
Interesting. From my experience as when I was running an altcoins liquid mostly strategy at Altana Wealth, we had literally like a 12 tick box kind of criteria set. So, team, obviously one of the most important ones, the tech, market adoption, the utility, where you are in the market cycle, the narrative was super important. But I have to say, I think I joined Patrick here, mostly the team was the most important kind of criteria for us. I mean, have they delivered before? Have they... Some of the teams, obviously, they change, or they, if they can't deliver after a year, they literally change completely projects or change blockchain, etc. For the most hyped one, we tend to avoid these guys. We want obviously persistent teams, ideally teams that have delivered before, and obviously passionate and also good at marketing. That's super important for investment, I think. Okay.
Sorry, maybe to quickly jump in on that. So the team, that's where it starts, but that's where it ends, right? So that's the reason why we invest in people that have probably 3 years to 8 years track record. They took the time and effort and money to actually set up a fund rather than just run an SMA product that you can move on if it doesn't sort of work out. And they probably have been on that journey for much longer, so they have seen the volatility. So again, it's not bulletproof, but it lowers the risk.
Perfect. And just before we end this panel, obviously we'd like to, maybe a lot of people here are interested to have your views about where you perceive the best opportunities in the next 3 to 5 years, right? Which bucket of investment styles, market neutral, long, short, systematic, or shall we just hold Bitcoin and sit on it? Again, obviously history has showed us that that's probably not too bad. What do you think, Patrick?
So personally, definitely have Bitcoin and sit on it. Don't do anything with it. Lock it away, and if there's a market drawdown, buy more. When the market goes up, don't sell. So that's the most important thing. So if you don't do anything else,
Dollar cost
remember
average
this.
on Bitcoin.
Dollar cost average in, but then don't rebalance on the way up, because otherwise, if you say I want to have 2% Bitcoin allocation, Bitcoin doubles, and then you sell half your Bitcoin, then
Diamond
you're making
hands.
a mistake.
No
Yeah,
selling.
diamond hands. Diamond
Okay.
hands. And then secondly, don't use leverage. Very important. Thirdly, I think at the moment what is exciting for me is what I would call liquid venture. So there's a lot of token projects that are in the market that have liquid tokens that are wildly undervalued, because there's many projects that have gone out, like maybe in 3-4 years ago they were up a lot, and then they came down in the bear market, and they're now kind of half forgotten, but they have very good tech, they have good teams, they're engaged teams, and you don't need to wait. So as I say, like, invest a lot in venture, but now at the moment I'm investing less in early stage venture, so I'd rather I'm allocating more in what I call liquid venture. So basically finding these good teams that have good projects, that have a lot of potential, and that have revenue. And so basically say, double down on those and try and help them elevate their story, because story is very important in crypto, right? Because, so that's one thing I'm looking at. And then from a liquid point of view, I look at late stage pre-IPO stuff. So from a systematic point of view, I don't invest in anything that's not market neutral crypto, because for me that does make no sense. If I want market neutral, I go into something regulated and boring and have a market neutral strategy there, because if I'm taking crypto counterparty risk, I want crypto upside. If I want market neutral, I want no counterparty risk, and that doesn't exist in crypto. So that's why that's not for me, but for other people this might be nice. If they have a hedge fund allocation and they like market neutral to start with, they can maybe get a little more yield from crypto market neutral. But as for my portfolio, it doesn't make sense.
Okay. Where do you see the space, or the most interesting part of the space, be in the next 3-5 years?
So I think there's kind of 3 key areas. So the first one, I agree with Patrick. Just hold Bitcoin, have it in self-custody, don't give it to anyone, have a good allocation. Whatever happens is yours, right? So you don't have the counterparty risk. Second, have Bitcoin, but do something with it. So that's why I quite like basically BTC share classes, where you invest Bitcoin, you take some risk for sure, but you can generate 5 to 10%, probably not more, on Bitcoin. I think the days when you could generate kind of 20% per year, I think are gone. So I think, again, good to accumulate more Bitcoin, but yes, you're taking more risk. And then 3 is what I start seeing more and more is credit funds from traditional finance. So basically traditional credit funds are being put on chain, and hedge funds basically can invest in those and can get extra leverage against those. And then these are the loopings, right? Where you can basically do that trade 2 or 3 times. Happy to go into more detail how it works, but you have someone from traditional finance, the Apollos, the Aries, etc., who are underwriting these loans. You are relying on their origination, on their due diligence skills. Is definitely not riskless, but I would say they do way better underwriting job than a lot of people in digital assets. And so there's a way how you can again generate extra yield. But for that, go through a hedge fund, go through a specialist. Don't try to do it at home, unlike the first one.
Awesome. Which obviously would preserve our jobs as well, right?
Self-serving, obviously, answer.
Self-serving, exactly. From my perspective, obviously, I mean, Bitcoin has been king, but it's like in TradFi as well. You don't want to just hold gold, right? Bitcoin is digital gold. You want some exposure to S&P 500 or Nasdaq, right? You want that Nvidia volatility, that those tech companies. So from that perspective, you probably won't get that with Bitcoin. So you might want to have some exposure to the composable chains, right? The Ethereum, the Solanas, the Suis, if you want some sexier exposure. But definitely look into the but again, as Patrick was saying, don't have that exposure with the perps market, have it in the spot market, sorry. So definitely do that. No perps, guys, no perps. Or if you do perps, then do it without leverage, i.e. long shorts. For example, my strategy, I trade perps, but zero leverage. I'm either long or short. But obviously, again, if you just want exposure in the space in a spot manner, again, digital gold, Bitcoin, have some composable chains to diversify, to akin to the S&P, Nasdaq, as we said. You've got Ethereum, Solana, Sui, for example. And also, I mean, Patrick is not so keen on market neutral or more active investment strategies, but I think, in my opinion, to lure traditional asset managers into the space, they like to see those stable returns, and for them, obviously, 10% or 15% annual returns is actually a lot higher than any other TradFi instrument can provide them, right? So I think it's still interesting to pursue those, those market neutral strategies. Obviously, what we have seen this year is some of these market neutral strategies haven't performed as well as 2024, just because funding rates have gone down. But there are ways still to achieve those kind of returns in a very risk-adjusted manner, right? Before we close the panel, I'd like to actually ask you a question. Do you think that that recommended 1 to 5% Bitcoin exposure from Larry Fink and the big money managers, do you think that will remain as low as 1, 2 to 5%, or do you see that recommended diversification, Bitcoin exposure growing more to the 5 to 10%? I'm talking about the big guys, the Vanguards, the BlackRocks, etc.
So I think that anyone who has zero allocation, they are actively taking a view that Bitcoin is worthless. And if they don't have a view, then they should probably basically copy the normal allocation, which means Bitcoin is 2 trillion out of, I don't know, 950 trillion overall assets. So they should probably have a similar allocation, which is obviously still very small. I would adjust that for a number of factors. I think that allocation will grow 5 to 10%.
Great.
Yeah, I think 3 to 5% is a good starting position. And then, as I said, if you don't rebalance, it will go to 10% eventually, right? So that's the main thing. You don't need to change your allocation. You just need to let crypto do its thing, right?
Okay, so start with 5%. Don't take profits if it doubles. Leave it at 10. Thank you so much, guys, and thank you for the audience.
Thank you.
Thank you.